Welcome to our webinar, and thank you for taking the time out of your day to join us. We're happy to partner again with one of our most popular speakers and a professional trader with over 30 years of experience to bring you this interactive options trading session today. My name is Gina Bocayas, and I'm on the management team of Regal Securities, which is the parent company of eOption and its sister company, InvestTrade. A few housekeeping matters. The session today will last approximately 1 hour. We ask that you take a moment to locate the Q&A box on your screen. Please enter all of your questions here throughout the webinar, and our speaker will get to them as soon as he can. This session is a lightning round, so we encourage you to ask away. And to tell you a bit about eOption, we offer you many options for your trading. You can trade stocks, exchange-traded funds, bonds, and mutual funds. And of course, as our name implies, we love and specialize in options trading. We offer you some of the lowest rates in the country, including zero commission on stocks and ETFs, and options are just 10 cents per contract, plus $1.99 per trade. We also offer an easy-to-use trading platform, as well as lots of free trading tools to help you spot those trading opportunities out there. Also, a recording of this video will be available on eOption's YouTube channel and our website in the next few days. And so before we start, I'd like to just walk you through our disclosure. Options trading does have risks, and the information presented in this webinar is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security. And also, the views expressed during the presentation are those of the speaker only. And if I can turn your attention to the last bullet point, options carry a high level of risk and are not suitable for all investors. Certain requirements must be met to trade options through Regal or any of its divisions, including eOption. Please read the options disclosure document titled Characteristics and Risks of Standardized Options. And we have the website for you, and you can also contact us directly, and we're happy to provide that booklet for you. I'd like to turn our attention to our speaker now, Teddy Keckstadt. He did the first 2 interactive trading sessions with us this summer, and this is the third and the last of the series. We'd like to welcome him back today. Teddy is a professional trader, and he has over 3 decades of trading experience. He traded on the Chicago Board of Options Exchange, Chicago Mercantile Exchange, and Chicago Board of Trade for 21 years, and has been an institutional market analyst for over 25 years. He serves as president of Forex Trading Unlocked and is the author of High Probable Japanese Candlestick Patterns. And he has a degree in finance from DePaul University in Chicago. So without further ado, I'll turn it over to Teddy Keckstadt and we'll get started. Thank you.
Okay, thank you, everybody. Thank you, Gina. Appreciate you guys showing up for today's webinar. And just before we get into it, I want to show you my disclaimer, just like Gina's. It's pretty much the same thing. Just reminding you, this webinar is for illustrative and educational purposes only. And right now, all you bulls and bears, let's get ready to see what's going on in the marketplace. All right, I have the eOption.com website pulled up here for the trading platform. This is the paper trading, which is the same as the real one, just obviously not with the real account. And let's take a look at how this is set up here. We're going to use the different parts and features of this trading platform while we go through the webinar today. So first we have the daily outlook, which is pulled up here on the first tab here. It has lots of information that I would recommend that before you start your trading day in equities and options, that you definitely take a look at it. It has a watch list tab here that you can set up certain things that you want to keep an eye on, what have you, depending on what you're trading or having investments in. There's a charting tab also. There's a research tab also that you can use to do find out information on various equities and options. There's an option chain tab, which is fantastic for finding different strike prices and seeing what kind of volume is going on in the different expirations. It's definitely good when you're trying to lay out certain longer term plays when it comes to options. Then you have your trading tab. We're going to definitely be using this one today. You have a positions and order tab that tells you when you have something. Right now we have nothing, so we're going to fill that up with a couple today. And then there's a news tab also. We have a screener tab, and well, this one takes a little while to load up. I probably shouldn't have hit that one. It'll come up in just a second. All right, there we go. So this one has a lot of things going on here. So it's something that we don't want to really spend time on the webinar with. There's an options play tab, which definitely I would reach out to eOption and learn more about that. Gina might mention something at the end of the webinar about that. And you can have also an alert tab too to set things up. So before we get into any of that stuff, we're just going to put it back to trading. And we're going to take a look at the charts right now. So the SPY is an ETF trust based off the Spider ETF S&P 500 index. And as you can see right now, the trading is not too crazy today. It's actually been a rather quiet day. We have the Jackson Hole conference that is going on with a big crescendo on Friday. We'll see what kind of announcements do come out from the various central banks, what they're talking about and their takes, if you will, and plans that they're trying to outline for the future. We know that right now the U.S. Fed is the most hawkish of all, meaning they are bullish on raising interest rates. Most of the world around us is to some degree either dovish or not very hawkish, and definitely not the stance we are. So this is important about what's going on in the marketplace. It's going to drive the volatility. So the S&P/Y index, let's take a look at what's going on here. So we're going to look at some options on this and what we can look at and what to do. So first, let's use this to set the trend. So we know what, when we look at the other stocks, the individual ones, kind of they have some sort of directional bias by the overall market. So as we can see here, I have a couple of indicators and a couple of moving averages here. The green one here is a 100 period moving average, and the blue one here is a 50 period. So right now this is on a daily, so that'll be a 50-day moving average and a 100-day. Those are both very common numbers. The thing that you need to notice is that even though the market has been trending up since the middle of June, you can see that we had a nice bottom here and the market's been trending higher overall, at least for this index. The averages, which always are in a lag, are still trending lower. The 100-day moving average is still above the 50-day. So that means overall, even though we've had a bounce, the overall market trend is either neutral to definitely not bullish yet. Then we have this MACD indicator, which is a very common indicator you can find on almost every trading platform that does show the market being oversold right now. And it does have the, when you see the oscillator go below the zero line here and starts to go red and it coincides with the cross, that's usually an indication of a short-term potential stall in a trend or potential turn in the trend. The only thing is right now it's kind of mixed. We have mixed signals, and this is why we want to be careful with what kind of options play we put on. So I think that what we're going to look at when we look at the e-options here, we're going to look at putting on a straddle play. Okay, so and when you do a straddle play, that's where you're going to be buying one option and one put, or you could be selling one option and one put if you're selling the options, but we're not going to do that. So we're going to use the trading section here and line out a trade once we figure out a level. Okay, so what we're going to take a look at is I went to go to the option chains real quick. All right, so in here we put the SPY. And we know that the market is trading right now at, what is it, 314, or excuse me, 413, excuse me, 413. So we're going to go down to the 413 strike price, first of all, and see what's going on here. Let's see how active this is. And we can use this a little bit faster, maybe. Okay, there we go. Almost there. There's a lot of options when it comes to any stock or especially on an ETF. All right, 413, we can see here, we got some good actions going on here. As far as the change here, the bid size, yeah, we have a good contract numbers here as far as the bid size over here on the puts and also on the 414s and also the 413s. We have a good bid size. We have a lot of contracts being traded at this 414 strike price. Now, this is key. On the calls, we have a ton more volume, actually. Let's see, we have the size here is typically around 700, and here it's a little bit smaller. So at the money strike price, which is pretty much you're on that strike price. Now here with this here, we have every dollar in the index. Usually with most stocks, it's $5 to $10 apart. Okay, but the indexes are a little bit different. So we can see how active the 413 and the 414s are. So we're going to go back and set this on our trading and go back to our chart. We're going to show where the strike price is here. And then we're going to figure out what kind of option strategy would behoove us to put on. All right, so we're going to set this at 114.13 even. Okay, so this median line right here, 413, is going to be our level that we're going to use to figure out whether we buy a call, when we buy a put, or whether we put a straddle on. So from our analysis here, we can see that the indicators are showing that the market is overbought, looking for a potential turn. Okay, we already discussed that the moving averages, as far as a trend, still has, even though it's a lagging indicator, has it in a neutral to not bullish trend. That's for sure right now, until you would have this blue line cross above the green. That would be an indication that the overall trend is starting to turn. So right now, this one here is pretty neutral to bearish. This one here is oversold. Remember, I said this oscillator here is also very negative. So one thing would be is you could sell the ETF if you already owned it, saying, you know what, maybe it's time to take a little profit and or wait to buy it down lower. Or you could put on a put outright right now, and we can see what the put cost would be. That's the SPY, and this is really good. And you can just go to, let's see here. We want to see where the straddle here is. Okay, so we're going to put the 413 is our price. Okay, so the nice thing about this is we can see the cost right now. So if we put on a straddle, when you buy a straddle, that means you're going to be buying the same strike price for a put and a call. So in this case, for the SPY Spider, it would be a 413 call and put of the same expiration. Okay, so same strike price, same expiration. The only difference is one is a call, one is a put. Now, if you were just bearish this, like let's say you want to look at these oscillators and you're like, oh, well, the averages say the trend's not a bull yet. The MACD is saying it's oversold. Maybe you just buy a put. Well, if you just bought the put, we can see that the pricing on the put right now is $873. Okay, so that would mean $873. If you were to buy the call and happen to be bullish, then that's $838. It's a little bit cheaper than the put. Remember when than the put is. Remember how the volume was, which was switching between the 413 and 414. That's because we were looking at the 414 when the volume was actually higher on the call ratio on the call side. But when I looked at the 413, I'm like, oh, look at the volume on there. And that's because this one's in the money. So the call is right now. So the put right here is at 413 and the same strike price is for the call. So we lined up those and we're going to take a look at this on a weekly just to double check. Okay, so the overall trend on the weekly is down. So remember we had those moving averages and the oscillator that looked like it wants to sell. Okay, well on this one here, you have the lower move lows, lower move highs, and it's not very positive on that one either. So you can see where from the weekly, we pull this down. Look at how this resistance comes in here. This is where a trend line is. So for a breakout volatility trade, not knowing whether you are bullish or bearish, this is the time where the straddle play looks really, really good. We have a big Fed conference with all the central banks happening right now this week, the crescendo on Friday. Are we expecting any major announcements? I wouldn't expect a turn from the Fed from their speak because that would not really make very much sense, especially when they just came out over the past couple of days where it looks like they're getting more hawkish once again going into the meeting, which is on September 20th and 21st. So Wednesday to 21st. That's another thing we got to look at. So we got our strike price. Now we're going to figure out our our time expectation. So we'll get to some questions and some comments in a couple of minutes after we finish this trade. So now let's figure out how to get to that area. So if we go back to our chart and we pull this out, we know what obviously today's date is, right? It's the 24th. And we know that in September on the 21st, this is the Fed day. So let's make this a little bit easier to see for everybody and make it a solid line. There we go. Okay, so right here, this is our little marking point. We know that expiration happens on this day, and we know that no matter what, since whether we want to put on a put, a call, or a straddle, we want the market to move away. Now, there's a good chance that since we see this downward sloping resistance, if this is just a correction then right now we shouldn't be getting above this line here, and we should start trending lower with the longer term trend. If this correction is going to extend itself, or if the market is turned, we'll take out this high, this downward sloping resistance, which would confirm strength and definitely help either a call position or a straddle. And that's why we're looking at the straddle, because right now with a lot of indecision in the marketplace, it makes sense. So now we got a time frame right there. So now we're going to go back to our thing here and look at the September. So we have September 19th, we got a 21st. We have a 20th. This is on the weekly. So let's go the week of the 23rd. Yeah, week of the 23rd. And now we got to reset the strike price because we changed that. We go to the 413. We go to the 413. Right here. Okay. So now we put a call in here and we have a put in here. So now we have it all together. So just to review, we are buying to open both of these options. Remember, we have one call, one put. Okay, so quantity is both one. You can see that. Then we have the expiration date. Remember, it's very important. The expiration must be the same for both the call and the put. If they're not, that's not a straddle. It's a different type of option spread. That's a completely different, it's a complicated one too. We're not even going to get into that. So please, no questions on that one. Strike price 413. Remember, one is a call, one is a put, and now we see the pricing here. So remember, if you wanted to be just long a call, right now it would cost you $9.58 or $959. Or you could buy a put if you were bearish, okay, thinking that maybe this correction was done with the SPY, okay, and then that would cost you $10.18 or $1,019. Okay, now for the total spread that we're talking about here, it's $19.75. So when you hit the order button, boom, and you can see here with the cost, of course, it just moved a little bit on pricing, excuse me. So that moved is now $19.84. So the total commission or cost is $39.80. You have your commission per contract. Altogether, it comes down to $39.88.32. Hit the trade button. It is now executed and filled. So now what we do, you can go to your positions and orders tab, and you can see right here that we have both a put and a call. And you can see the pricing, that the average price that we came in, and the P&L where we're at right now. So it's only slightly down because we just bought the bid. Obviously, if we sold it out right away, we would be, we would be selling the offer or selling the bid. And so anyhow, we have this position on. Now we go to our account summary. It's also in here. So account summary tells you where your market position is, where your P&L is on the day, and also your total value of your account, how much you have left as leverage, or to outright buy things, depending on whether you're buying equities or just trading options. And this is where you can monitor your position. So right here, once again, it shows you the quantity, and we have this trade on. So sometime between September 22nd and where we are right now, we want it to move. So how far does it really need to move? Okay, well, that's a very valid question. So the longer we get the closer we get towards expiration, obviously the time premium disappears. The good thing is when you're trading a play like this, is you want to usually be somewhere between 25, 30 days to no more than 45 days out. Okay, so this is actually a perfect option trade for as far as a spread. Reason being is that as far as the time decay, there's only basically 4.5 weeks left. The amount of time decay isn't that much left in these options, meaning that these same options, had you purchased this spread 2 months ago, your time premium will be so much higher. So even if the market was at right now, obviously you'd be paying the time premium. The spread we just put on would be much more expensive. So that rate of decay is pretty much mostly absorbed. You know, you can kind of think of it like when you're paying off your mortgage. Time decay is kind of like your mortgage. When you have your first 10 years of your 30-year mortgage, you're paying mostly interest and not much principal. By the time you're on your last 5 years, it's almost all principal and there's next to no interest, you know? So, I mean, and that's the same thing when it comes, you can think about that when it comes to option valuations. You know, time premium is kind of works like a mortgage. The closer you get to that the expiration or the ending of that note is the less interest you're paying. There's the premium that's left is the actual equity. Now, the same thing, just like a house, if the value of your house goes down, the same thing as with an option, meaning that if the SPY, if we were to just buy the calls, for instance, and the SPY continues to go lower, well, obviously the time premium is irrelevant because we're going to lose because the strike price would start to become out of the money in a bad way, meaning that the value of the call would go down. Now, the value of a put, obviously, in that situation would go up, because if the market goes down, like we're looking at the potential for that to do, then that would be a good trade. And conversely, if the market does rally, where the call would be good, the put wouldn't. So the straddle in this situation is a very, very good thing. So now, as far as how much does it need to move? Well, we have basically a $1,000, excuse me, we have the basically a $1,900 premium in the trade. Okay, so we know that we are looking to basically look for a move up until this date. So are we waiting for the announcement on the 21st of the Fed? No, that's not what we're waiting for. We're not waiting for that at all. What we're waiting for is a move into that economic number or event, if you will. It's kind of a both thing. Fed events are not just an economic number. CPI and unemployment is not so much the Fed. So between now and then, it's very likely that we are going to make a move in the market. So just like we know there's that upside. Let's take a look at real quick this trend here. So the reason I suggested a straddle versus a call or a put is that we do have we're at an inflection point. The market can go any direction for one. The current trend in the short run is bullish, but it has lots of negative signals, and the overall trend is bearish. So right now we have the short-term trend. It came down and took out the support line that was holding the short-term corrective trend up intact. This here is a negative sell signal. You combine it with this sell signal, and remember the averages, how they are the 200, or excuse me, the 100 is still above the 50. That's very negative, the market. So as far as what we're looking for is distance now, let's try and see. We need a $10 move, which would be really, really good for this trade. So if we get down to 403, let's move this to 403. Let's change the colors. Oops, that's probably too bright for you. Let's do something a little more like this. Okay. All right. And then we'll put one more here at 423. Okay. Oops. All right. This will all be clear now as far as the ETF strategy here, or excuse me, playing the ETF straddle play. Okay, so we can see that here's today's session. So just in the past 3 sessions, the market was trading above 423. If the overall trend is there and wants to resume itself, if this is just a short-term sell-off, little profit-taking move, if you will, then odds are very likely that we'll get another blast higher, take out this previous high, and trend higher into that Fed day, or at least make a run for that area. All we need to do is get above 423 and come near these highs. We can take out the straddle play at a profit. Then the question is how long do you want to see if this can move or not? I would say the best thing to do is look at both what your real risk is on the upside and the downside. So let's just say for short-term targets, where can we go? Well, the nice thing to know is that to the downside, if you go by the old trader 50% rule, we're pretty much right there. Okay. And then also, let me do the extension. This will put it up. Oops. This puts it right up here. Okay, so now let me clean this up. All right, so if you were looking at a price projection ratio kind of thing of whether or not we're correcting or not, let's just say the overall trend wants to go higher in the long run, but we're still going to take a little more heat to the downside, kind of maybe mess with this position, make the puts look good and make the calls look bad for a little bit. And let's say the market gets down to just this area here, which would be a 50% correction. That right, just from this one little move here, that puts us at a nice spot to get out of this trade. If we hit this line right here, this pricing right here, or we hit this area right here up by 427, which comes right into where the market might cap out too. You got this downward sloping resistance, keeping the long-term trend intact. Within the next couple of weeks or couple of sessions even, we could hit this area or this area right here. So what does that mean for us as far as our options trade here? So for our options trade here, that would give us the opportunity to come out at a profit, but way before the expiration, because you would still have a little bit of time premium in. Volatility would still be high. And we have enough of a move that you're already at towards your break-even threshold for the trade, to where no matter what, if the market continues higher or continues lower, your downside risk from your initial capital outlay is already met. So you don't have to worry about that. Then it's a matter of how long do you hang on to it. So you don't want to get too greedy. I would say, especially in this situation, since if it's only a downward correction right now, then right now taking profits right here would be a perfect time to get out, take the money and run, especially if it dips below that during any type of, if you have any opportunity there. And the same is to the upside. If we come back up here, I mean, could we fall off of it and reverse? Anything can happen. But odds are, if we do come back up into this area here and take out this high especially, well, then you could still have an accelerated move to the upside. I would use caution with that one. But I think that no matter what, between now and September 21st, because of the Fed speak that's going to happen this week, then we know after this week that we have a Fed meeting on the 20 and 21st, where odds are right now that they're going to at least do a half a point. And it's more likely they'll do 3/4, because that was the initial forecast. And now we have Fed chairman's talking about how they should do a full point. You know, so it's very, very hawkish. Now, I would not worry about whether they do what, is how much. It's a matter of that we know that they are going to raise. That's not very good for the stock market. So that's why I would say if you go to the upside, think about getting out right away at this area to the upside. Now, to the downside, that may not be something you want to do. You may want to give it a little bit more time to see if it tests support, for the mere fact is that as they raise rates, especially going into earnings seasons, it's very likely that you're going to see a hit in some stocks. So with that, let's go to let's see the panel here. Okay, let's see what we got here. Questions. All right, we got some people out there. All right, so definitely ask some questions if you want about this. So let's talk about something that's been in the news today, and I know you all know, is Peloton. We've looked at Peloton before. I don't know if any of you on the chat room are watching this video. Let me know if you own this stock or if you heard the news today about Peloton making a deal with Amazon. I know you all know who Amazon is, that's for sure. So yeah, they sold some sort of agreement today where they're going to start selling not just Peloton machines, but they have their whole sportswear and all kinds of other stuff. You know, there's a couple different angles to their channel of what they sell for their sales funnel. So the one thing that'll be interesting is, how do you deliver 800-pound machines through Amazon? That's the one thing that might be a little bit tricky. So, but anyhow, the deal was struck. Peloton, as you can see, their stock has been trending lower for a while. There's also a new CEO, and which is a good thing, because the last one was way just I don't know what page he's on. So the market wants to see what's going to happen here. You can see that the market's been trending lower. The stock is very beaten up. Ironically, though, just like the last situation, now we have a market that's been trending lower. You can see that the 50 and the 100-day moving averages here. This is where the 100 is on top. Once again, the 50 is below, meaning negative, and it's tilted lower. So until we get the market above these averages, at least, it's hard to be very bullish on this stock. But it doesn't mean that it's not going to pop. It also doesn't mean, especially like today, you can see how we had a lot of interest. It's settled where yesterday it was at 11.20, and right now it's trading at 13.46. So Nice little lift to the equity for a day. We'll see what happens. Right now, you can see that the oscillators are a little bit mixed. This is starting to cross like it was bought. Actually, hard to be overbought when you can see this thing's actually very down. But you can see that this slowing little rounded out bottom here, it just took so long. There's not much. There wasn't much for anyone getting along here. That's for sure. Your risk reward ratio was out the window. So the question is here is, we know we looked at the ETF about the broad market. We know it's kind of the expectations right now are very indecisive, but we could have an upside breakout. Anything could happen. Maybe the economic numbers get better and better as we move into the fall. I don't know. We'll see. It's hard to believe that when we all go to the gas station and the stores, right? So, but maybe that all does start to flatten out, and maybe even if it pulls back, that would be a good thing for a stock such as Peloton. It'd be bullish. Obviously, there's new sales channels and a broader market through the Amazon deal could help them out. And this is an opportunity where it's probably going to maybe have a really good chance at least doing something like this, breaking out of this range. So if you look at the bottom here, and we'll kind of put it like where this recent high was, we'll put it right there. Okay, so this whole little trading zone, you can see basically from May, it came down into here, and this is where it's been. It's really basically unchanged from the middle of May, beginning of May, to now the near end of August. Not a lot of risk overall for the longs, just taking a little heat. For those who are bearish, especially with puts, probably not doing too well. All the options were pretty mixed. So this was a really bad period. But now let's think about this. New deal, a lot of potential volatility in the stock market, maybe a lot of potential interest in Peloton. I don't know. What would you think about it? Let's take a look at what eOptions trading platform has to say about it. All right, so we're going to go to trading here, and we're going to pull up Peloton. All right, so we pull up Peloton. And since we're not really keen on direction, I mean, this thing is pretty beaten up. Could it go lower? Absolutely, it could go lower, especially if the overall economy is contracting. How many people are buying new treadmills and signing up for their monthly, subscription that runs through their treadmills and stuff? Not that people aren't going to do it. The question is, are the sales going to be that strong? And are they going to be able to maintain traction? Or is Amazon the new thing to really put some resurgence into them and help them clear out their inventories and get cash flow moving? I think you have a little combination of both going on. So let's see. We have the market trading at 1337. Let's go back to our trading platform and see the options chains. All right. So pull up Peloton. We're going to look at the September options too. We're going to do the same thing. Okay. There we go. All right. So now let's go look at this. We have the 1350 strike price. Let's see, where is the volume at? Let's see, bid size. We have $12. We got good volume at $12 on the put side. And let's see, call side, let's see, a lot lower. Yeah, so there's a lot, it's 10, not much. Looks like there's a lot, not a lot of interest on the, more is leaning on the put side than the call side. So let's see, we were trading at 1450. There is a 1450 strike price. All right, let's see what the volume is there. Okay, it's kind of thin. That's actually probably kind of too bad. All right, so we're going to look at the 1450. We'll go back to our trading once again, and we're going to Peloton here, and we're going to go pull up our straddle. Okay, and then we're going to go to our September 23. Make sure that those are the same. We're going to go to, remember, we just picked 1450. It's pretty much where the market's at. So that means they're at the money. At the money means that the strike price is basically right at the current market price of whatever equity or asset you're talking about. And oddly enough, and conveniently enough, there's a 1450 strike price. So that works out really well. Certain stocks, especially the tighter they get down, the smaller their volatility, the more tighter the strike prices get. In a lot of stocks, you won't see them spaced anything under $2.50 apart, let alone even $5 apart. So, but it depends on, once again, the size of the equity and the volume. So we have one call and one put. So remember, both of these are a buy to open. You're buying the spread. Its a quantity is a 1. We have the 1450 strike price, the one call, one put. Now remember, if we wanted to be long this, let's say we're like, hey, new CEO for Peloton, Amazon deal, the stock has been getting beaten up so much. I think it's done, you know, even as just a long-term investment. As a long-term investment, it might be a good deal. As a short-term trade, I don't know necessarily. That's a tough one. But we can look at the weekly here. See, this is where you got to look at how things, what is the potential? Sorry, I got to move this over so I can get this in here. Delete that. All right, so we're going to draw the trend line from here. All right, extend that down. Now, the good thing is that if you look at the overall trend, I'll go back to the daily. We're coming into a point now. It's still, you'd have to rally more than 100% just to start to get close to this downward sloping resistance line. But this is a target area. I mean, by attrition, by Christmas time, we would be actually coming into where the pricing is right now. I think that between now and Christmas, there's probably a little bit better chance of seeing a move, especially because of the news and with earnings coming out. All right, so there we know. Here's our expiration. Let's go back to the pricing. So let's see, 1450 is our strike. We know that we could right now, you could pay $1.74 for the call. You could pay $2.82 for the put. So if we're just looking at calls and puts, remember, we want to do a straddle because as far as direction, this stock could just keep getting beaten up like it has. Maybe none of this is going to matter anymore. Who knows? Maybe the only good thing is that Peloton may be a buyout candidate. That's another thing. I can see maybe possibly that happening actually, where a private equity group comes in and takes it out and then just slams management completely, which I think that would be a good move. So 1450 is our strike price. Let's change the color to black. All right. All right. So 1450 here is our strike price. All right. So we're using this one here because it's a little bit above the market. So right now the calls are in the, or excuse me, the puts are a little bit weak because the market's below it. They're a little bit out of the money. The calls right now are, they're doing all right. I mean, the 1450 puts are a little bit more in the money than they're in the money. Calls are not, but they're not very much in the money. So it's basically at the money options. And also we have this previous high here where, since we're looking for a directional play, if you wanted to break out to the upside to get that kind of action, this would be the good strike price to play because it's right at the high. Fresh buying, if this is going to move higher, is likely to come in as we make new highs. And also, if we're wrong, the put is rich. So that means that if this market goes down, the spread will actually come in our favor much quicker because there's already a little bit more put premium. So let's go back here so you can see. So see how the pricing here of the put is a little bit more expensive than the call. Once again, that's because the market is below that strike price. It's about 80 cents below that. So, and that little premium right there, especially if this market does break, helps this position. So a bearish move would actually come to a little bit more of a profit quicker than it would if it goes to the upside. However, a move to the upside overall may actually yield the biggest distance because, once again, remember, this market's been trending lower, but in the short run, what's it been doing? In the short run, it's actually trending higher. We set a low. We have this market at a very, very slow, tiny slope moving higher. And we've been making higher. We made a higher move high, higher low, higher high, higher low, higher high, higher move low. The question is, now what do we do? So I like this trade right here where we have the 415 call, 415 put. All right. The total cost here is 453. We verify it. You can see the total cost here, commission, blah, 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 457. but the execution and the total cost was 457.32. Once again, you go to your positions and orders tab, and you can see now that we have our SPY trade that is now in here, and we also have our Peloton trade that is in here. It tells you the P&L, which you are up and down. Okay, and also you go to your account summary, which does the same thing. So right now, between the two option spreads that we just put on, we can see that the unrealized P&L is down 26.50. Well, that would be pretty much the buying the bid, selling the offer. If we were to get in and out of these, just getting in and out of these trades. So, but these we put on because we have an expectation of some very good market movement before expiration. So now let's look at the cost of this trade. Remember that it costs 450. That's a beautiful thing. So as far as market movement, let's make this a little bit easier to see. So 450 from where we're at right now. All right, there's the expiration there. Let's go into, so we got $10 there. Okay, so basically, I'm gonna reset this price to 10. This to 19. Okay. So as far as what we need on pricing right now, from where it's at, how much of a movement do we need? If before expiration, we get up to this $19 or excuse me, at expiration, as long as the market would be at 19 or higher or at 10 or lower, we would have a break even. We have all our money or plus some. And then depending on how close it is would be how much we would have on one of the legs. See, here's the thing is, unless this market goes nowhere with the straddle, we will make either some money on the calls or some money on the puts. Right now, it'd be nicer if it goes to the put side just because of the fact that it will get down there much quicker. And we have a very good, like I said, chance that with what's going on with the Fed right now, unless they say something between now and Friday while this big central bank meeting is going on with all the central banks from around the world, if they change their major hawkish stance, and I know they're not going dovish, that would be that would definitely make this. Then the straddle is the right play, folks, because we will have some serious volatility. I can't tell you what would happen, but I guarantee you that the stocks and all the stock market will be radically changed from wherever it's at. So we have this little area here of direction that you got to remember that before that, let's say that over the next week or two, everyone likes this news. Mutual funds and stuff start saying, hey, let's buy Peloton. Let's buy Peloton. Let's say the market gets up somewhere up in this area in the next, I don't know, say week or two, in front of the Fed meeting. If you're already up in this range right here and you already have a little bit of a profit on this spread, I would say get out of it, just because anything goes once we get to this end point here of when we have the Fed announcement. Remember, once again, the odds are very high that they're going to raise at the very least 50%, and it could be 75%. And there's even a slim chance of 1%, especially because now you have Fed governors talking about it. Also, if this is true, and the Fed has a very hawkish stance going into Friday with these central banks, unless they start to get on that same page, which right now you have China that's cutting rates. You have Japan that is staying dovish. You have a couple other countries that they were starting to get hawkish and they're pulling back. So there's a lot of that influences a lot of markets that definitely impact the stock market. There's a lot of moving parts right there, and this webinar is not about that, but we are at an inflection point. So it's a very good time for volatility. That's why we haven't been talking so much about call plays or put plays. So let's see what we got here for questions. All right, so let's see from Brad. When putting on the SPY straddle, if you got a pop, would you sell the call and hold the put to sell later at a pullback in the stock, vice versa? Okay, very good question. So what Brad is asking is for the SPY, I can pull this back up, oops, let me get rid of that. Don't need that anymore. Let's get the cursor here. Okay, So what Brad is asking here is if we did get a rally up in here, would we sell the call, especially if we thought that there would be a pullback? That would be something that's a total webinar in itself. It's a great question. For this play right now, absolutely not. Now, do you have that choice once you get to that point? Absolutely. If you think that the market's running out of gas, but then remember, you've are turning one, you're legging out of a position and creating another position. Okay. So unless that's your original intention, I would say don't do that. Now, if you're putting on a straddle or a strangle, you could do the same thing. And a lot of times options traders will do that. They're looking, they're not necessarily, they have a bias, whether the market is either bullish or bearish, depending on the asset, not necessarily overall market. And they will wait for one move to happen. And if it's a counter trend move and they really don't believe in that counter trend move, and they really think that the overall trend will come back, in this case, that would be bearish, then I would say then you would do something like that. So great question. That's an advanced type of market strategy. I've done that. I know plenty of people that do that. I would definitely say not for a beginner. For a beginner, stick with your plan. Always have your money, know your risk, have your targets, put on your trade, know exactly when you're going to get out. Once you get to a certain profit level, take your profit. Or if you have a certain time frame where news event, earnings come out, you didn't get the move, and as the position just starts to volatility drops, market's not going anywhere, whatever your particular underlying position is, then you got to get out of it. When things don't happen, stick to your plan. So, but good question. You can move around like that. And it is a great way to play swing trading, which is a totally different dynamic, which we could definitely do a webinar just on that one, on using especially different trading strategies and using buying sell signals for that. Great question, Brad. Let's see. So thanks for the webinar. When you close the trade, since we call which one close first. Okay, good question. We have here, which do you close first? You would close them simultaneously. So when you put on, that's where the question Brad just had is, would you leave one down maybe for this? If you were going to start to leg basically into another type of strategy or position, then you would only be getting out of one option. In this case, get to your target level or your time frame, and then you execute the position, get out of it. Do not hang on to it. Now remember that because you are buying the options, you don't have to worry about any exercise risk. 9 times out of 10, you don't need to worry about any exercise risk. It can happen. I actually just talked to somebody who is at a different brokerage house than the option about a position he had out for a customer a day before expiration. But that was because they were writing options and they kind of fell asleep on it. And that's why it happened. And we're not talking about that. That's for advanced trades. But good question. Absolutely get out of them both simultaneously. All right. In reference to, let's see. Yes, that's got that one. Let me see. We'll get to the next question. Is it a good idea to have the same price for the put and call? Tony, in our case, for the straddle, it has to be the same strike price. If it's not, then it's called a strangle. So for instance, like here, we're looking at the SPY with the 413 strike price. If you were to say buy the 413 call, okay, and buy the 412 put, that would be a strangle, which is similar to a straddle because you're buying the same expiration month, but you're buying a different strike price. So yeah, great question. But yes, for sure, for a straddle, and for this, it's not that one is simpler than the other. I just like strangles. Like for instance, for the first question I answered from Brad, if you are trying to trade a correction and leg in or out, or you do have some sort of bias overall, like meaning that, for instance, with the spider trade, if I was viewing this, which I am right now, as a correction, where right now I'm looking for this market to trend down into the Fed meeting over the next couple of weeks. Not that I'm overly bearish, but I think that it's been trending higher for a month and a half. I think it's got a good couple more weeks to the downside. In that case, instead of just putting on a straddle, another play would have been to put on the strangle and then where the market right here is at 413, I would have done, instead of 413 for the call and the put, do 413 for the put and 414 for the call, because I'm expecting the market to go down. So I'd rather pay less for the call and have more of a premium on the put, because if the market goes lower, I'm not losing as much on the call and the put's gaining. So, I mean, it's in it. Now that's, it has to be in a scenario where the market goes lower. If the market goes higher, yeah, I may still make money on a strangle, but not as much as I would have had I played it the opposite by positioning the straddle different, or excuse me, the strangle differently, or using the straddle. So yeah, great question about that one. Let's see, P-Time tomorrow's earnings should report, should move the trade. Also, would 16 September be better? Open interest. Yeah, well, here's the thing is, the earnings come out tomorrow for Peloton. I would expect that the forecast for earnings is pretty much downgraded as much as they can. I would not expect them to beat forecast by very much. If they do beat them, I don't think that they would miss them by much. And regardless of whether they do or not, I think that moving forward with the new CEO, and especially with this new Amazon deal, if earnings were bad, especially, that it may actually be a buy signal for the Peloton, because expectations have already been so low. That's why the stock is so broken down and beaten up, that it may have found fair value floor for the short run, meaning that they don't have to make much earnings. They just have to basically be flat or not losing, or maybe have a little uptick in earnings in the next couple of quarters. And that would be enough to give faith to investors, not traders. Investors. Remember, Peloton right now has got a lot of investors. If it didn't shake them out, it has them really worried about this thing. Plus, their equity is stuck. Think about the people that own Peloton up in the 40s and 50s. Now you're at one third of your value. That's equity. You can't, if you're going to sell out of the position, well, now you're definitely taking a loss, and are you going to try and ride it back? And what are you foregoing on other investments or trades you can make? So very good question. We still have time for a couple more. Let's see. How do you decide when to drop the call or the put in either play? Once again, Vic, for the straddle, you want to do it simultaneously. You have, like in this case with this SPY, if the market gets up above this 423, or especially if it gets above 423, and you know that you have a premium on your trade. Now, if it was to happen, let's say over the next 3-4 days, trading sessions, I might give it an extra week or so to see if it can make newer highs and get above this 427 area. But remember, it's already above our threshold. So if we take out the 427, that's already an extra $4 of premium on the spread. Don't get greedy, because we don't have a really big upside target for this. It's more likely to come down than it is up. And I'm not saying that it won't, but we put the straddle on for a reason, to not care about direction, ride the volatility wave that should spark a move, whether it's bullish to the upside or bearish to the downside. But we're not looking for an and we only have a certain time frame. We have 5 weeks. We're not looking for an overall major trend. Like the stock market, whether it's the SPY or the Peloton example, the market may be going up for the rest of the year. It doesn't mean it's not going to go sideways or have some pullbacks, and vice versa. So for this trade, we're not doing a longer term trade. When you start going out to, that's why I do most of these webinars based off of shorter term durations. If you start going out to 3 months, 4 months, 5 months, 6 months, not only are you dealing with bigger capital structure that you need to have to be prepared to trade that way, you're allotting and tying up a lot of capital for a long time, and you have to understand the risks. There's a lot of nuances when it comes to holding options or selling options out that far, and there's a lot of things you have to pay attention to. There's so many moving parts that unless you're very experienced, I wouldn't even start to worry about that kind of thing. So let's see, let's go to the next question. When initially putting on an options trade, how do you determine how far to go out for expiration? Okay, so that's a great question. So for expiration, especially in this SPY example or the Peloton, remember that we were talking about at the beginning of this webinar how we have the Jackson Hole Summit right now with the central banks. We're well aware of what's been going on the last 6 months, especially with the central banks, ours being the most hawkish globally, with a very hawkish stance, meaning raising interest rates that drives down bond prices. It also makes the stock market also under pressure often, especially with the US dollar getting stronger as well. So there's some other moving parts that because of those things that we don't need to care about whether it's going to make Peloton or the SPY, the spider, go up or down. We just know that there's enough momentum from these big economic, fundamental financial variables that we are pushing trends. We're either extending trends or we're reversing trends. The odds of us going sideways and choppy right now are very, very small. Okay. So now remember, especially with equities, they trend only 30% of the time. 70% of the time, they're like choppy sideways or just not really basing or, topping. So this is a good environment to know that the odds of trending are very, very high right now. So that's why you want to put on, like I said, you could put on a call or a put, but right now it's very hard to pick direction. There's a lot of indecisiveness, like when it comes back to Peloton, okay, we can go to Peloton and say this stock is overdone, overburied. It's been sold down. It is hit the bottom. Maybe it has. You put into light the new CEO, then maybe a new thought process with management. I don't think so. I think they have a very, very uphill battle ahead of them. Amazon, I think, is a good thing. I think that will help clear a lot of inventory, bring in a lot of short-term cash flow, especially on a lot of their lower price items and easily shipped items. It takes out a lot of thought process for them and can maybe in the short run stabilize a lot of their cash flows, and then they can adjust from there. But that's a whole nother ball of wax. So that would be a long-term call play or buying the stock outright. Those are totally different dynamics. For us, we're looking at just using this as a play because we have earnings that, and no matter how they come out tomorrow, odds are pretty good that over the next 4 to 5 weeks, Peloton, it's either going to slam new lows really hard or it might actually start to get up towards that $20 again. I would use caution. I think that once we start to get close to our target price here, especially if we can do it in the next couple of weeks, if you get above $17, $18 in the next 2-3 weeks, if you were to be long a call here or the straddle, I would say take a profit. And also the same thing is if it gets back down to $10 here, the low is down here around 8 something. We had this other major lows here where you have a lot of support. So yeah, if we can get below $10 and take out this area where we know we're going to be at a plus on the spread, get out. Absolutely. Now that might be a situation where you may dump the put and maybe hold the call because you're already like, well, it's riding the lows unless it goes, if you make enough money on the trade where it's a free option where you can keep the option and still take a profit on the spread, then maybe that's not such a bad idea. But then I don't know about that one. I still think it's not the way to go with that. That's when you start to, once again, you should have that in your plan being like, I'm waiting for a move and then I'll see if I want to hold the other leg. So great question though. Very, very good. What are the advantages and dangers between obtaining a short-term option less than 90 days compared to leaps? Okay, leaps, that's a whole webinar in itself. Okay, once again, once you go out, especially past 3 months, 90 days, there's a lot of things you really need to take into consideration because money management becomes crucial. Think about it like this, and this is a great way to end before I turn it over to Gina. You can maximize your money. Like for instance, if you're trading out 3 to 6 months, just on, think about our straddle position there. Okay. It cost, around just under $2,000 for going out 5 weeks. You're tying up $2,000 looking to make whatever return depending on the target. In this case, it'd be probably like around somewhere between a 10 and 15% return minimal, and that's a by expiration. If it gets to those breakout levels, or target levels up and downside for break even beforehand, you can make probably more upwards of 25 to 30% on the spread and get out of it. That is a good thing. Now think about it. If you make 20, let's say between 10 and 30% on 2,000, and you can do that in anywhere between 1 and 5 weeks versus tying up, say, 5 times that amount of money to make 10 or 20%, whereas in that time frame, you can probably do more 4 to 5 week opportunities where you may not tie up all that capital, but overall you'll make more money. I mean, think about it as like if you were to make, let's say you make 20% on the SPY trade, you make $400 sometime between now and expiration. Let's just say hypothetically. Putting it on the bigger position, going out 90 to say 90 to say 3 months to 6 months out, tying up say 10 grand or more to maybe make 1,000, maybe 2,000 over that time frame. That's where you have to start thinking about, is your risk reward better for one? And is your opportunity risk also, like, do you have more opportunities between now and 6 months than just these, say, doing now on a 6-month trade, or this, multiple ones of the ones we just covered today? So great question. It's also a very advanced trade. I'm not saying not to do those trades. Those are very good trades and can be very lucrative. You can actually make sometimes 5 to 10 times your money trading out those bigger trades. But you have to understand, and they have a webinar coming up about the Greeks at e-option next month, I believe. You have to understand those if you want to put those trades on. So great question, Johnny. And at the same time, this is a great time to turn the webinar back to Gina.
Okay, great. Well, thank you so much, Teddy. That was very interesting and informative. And thank you to all of our attendees for taking the time out of your busy day to join us, and all of your excellent questions. And if you have any more questions, we're happy to help. You can reach out to our trade desk at support@eoption.com, or give us a call at 888-793-5333, and we're happy to answer any questions that you have. Just a reminder, we do charge $0 for unlimited stock and ETF trades, and options are just 10 cents per contract. We do offer a powerful, intuitive trading platform and over $500 in free trading tools annually to all of our customers. And as Teddy mentioned in the webinar, we do offer Options Play, which is one of our free trading tools that scans thousands of stocks daily and highlights potential option trades that fit your goals. And that's normally over 500 annually, and that is free to all of our customers and is a hidden gem. And you'll also note that during the webinar that Teddy used our free paper trading platform. And if you'd like to try out some of the strategies that Teddy used in this webinar risk-free, this will allow you to use our trading platform and all of our features. You also get 100,000 in virtual cash to trade with. And it's easy to set up. It takes just a few minutes. You go to eoption.com, and on the home screen, you'll see a blue button that says free demo account. And just click that, and you just type in your name and email address, and you'll be able to open an account very quickly and start trading with us. Also, if you go to eoption.com, there are lots of resources on there. So we do have all of our past videos as well as clickable strategy links. So if Teddy mentioned some strategies during the webinar that you're unfamiliar with, you can click on a link such as a straddle or a strangle, and it'll go through a video and when you would use that strategy, and lots of great information. So I encourage you to check that out. A recording of this webinar will also be available tomorrow on our YouTube channel. So make sure you subscribe so you don't miss out on any of our videos. And we're also working on a new video now on how to place stop orders on your option trades. So that'll come out in the next week. So if you subscribe, then you won't miss out on any of our new videos or features. And if you don't have an account with us yet, if you do go to our YouTube channel, when this video is posted tomorrow, you will see a free stock promotion where we will give you free stock for a limited time. So it's a great time to open an account. And one of the best things about eOption is that there's no minimum to open an account or get started. So once you fill out the online application, you can get access to Options Play and all of our features that Teddy pointed out with our trading platform. And so you don't have to put any money in to start. And just to close, our next webinar will be Understanding the Option Greeks, and that's next month. That's Thursday, September 29th at 1 p.m. So you can reserve your spot today, and the website is on the page. So we hope you'll join us. We do about one webinar a month, and we'll also send you an email, everyone who is on this webinar today. So in closing, thank you again for your time, and have a wonderful afternoon. Bye now.